hours, and then upon receipt of a complete financing package, we generally fund in 10 business days. So we can move much more quickly than the bank, and our prospective clients, generally have a fairly pressing cash need. I also want to focus on the importance of developing a further relationship with borrowers post-closing and the importance of that. For example, once we're comfortable with the borrower and they've performed as they promised they would, and we have some real confidence in their management ability and in their company, we're often approached with overline decisions. Where, for example, a manufacturer is marshaling product for shipment on a Monday, but they need to meet payroll on Friday, and they're maxed out of their line. For the borrowers that we've become comfortable with, we routinely make those same-day overline accommodations.
So we've heard about the exciting and interesting alternative products. We know how to apply. Mark made the point earlier that you have to go in eyes wide open. So now we turn to the moment of truth. How do we think about pricing? So let's start with you, Eva, since you're here. How are your products priced, and how are your products priced and relative to a commercial bank loan? Let's use that as a benchmark.
Sure. So we definitely do risk-based pricing, and we're doing riskier loans from the bank, so our interest rate is higher. So we're typically between 11 and 18%, whereas a traditional financial institution is really going to base their rate on prime or LIBOR 3.25 with some sort of spread relative to the risk of the company. So we're usually a few points higher, but again, it's really just to account for the risk that we're taking with our borrowers.
Mark, we'll just go down the road and talk pricing.
It is as well risk-based pricing depending on your business, your personal information, but it'll run anywhere from 2 to 10% of your, actually 2 to 18% of your advance amount, whether you keep it for 30 days to 6 months. Ours is a 6-month product, so you can pay 2 to 10% for month 1 or month 2, and then anywhere up higher than that.
Our medium price merchant or medium credit-based merchant will probably have a factor rate. They use a factor rate because they're buying future revenue. So for every dollar we advance that we hope to get back over a 12-month basis, we're purchasing $1.22 of future credit card sales or future bank deposits.
One of the unique aspects of Franklin Capital, that in sharp contrast to other commercial finance companies, is that Franklin has developed a network of bank partnerships, and we very often 50-50 fund deals with our bank partners. So as a result, we're able to very often achieve pricing in the low teens, whereas typical pricing in the accounts receivable factoring space is in the high teens to low 20s. With respect to our purchase order trade finance product, we charge a point for every 10 days with a 3-point minimum. But very often, that ability for companies to finance for purchase orders that they don't have the ability to otherwise finance, they don't have, say, the availability under their working capital line of credit to accommodate, enables businesses to take advantage of orders that they would otherwise have to say no to.
I want to ask one last question to the panel and then open it up to the audience. And that's for you, Ami. Given what you see in terms of trends in finance nationally and across a range of sources of capital, what would be the advice that you would give to business owners in the audience to finance their small businesses?
The best advice is I think it's tied to the last question about pricing. Small business access to capital is like a bipolar world. We see loans with interest rates of 4 to 4.5%, all the way, if you calculate the APR, up to 200%. And the market is crazy. What you have to do is you have to figure out where you fit in the market. And it might be expensive, and expensive is okay if you have a coherent plan to help you get your business to the next level where you're gonna make more money than you would otherwise without the capital. But always try as best as you can to get at least 2 different options. Test it, and another piece of advice is the SBA is like this gray area where sometimes you can get a great deal, a great loan at a great price and save the heavy expense of the alternative financing options. So it's wise to work it and figure out what your options or alternatives are, and then figure out the best thing for you. If you can get 2 options and understand the trade-off and the pros and cons between the 2 of them, and decide what works well for you then you're in good shape.
So start thinking of your questions. I think we're going to cue a video